G'day, g'day. It's Stefan Angelini here on the 7th of March, 2023. It's a bloody exciting day because we've got another, rate increase expectation, or the Reserve Bank are coming out and saying whether they're increasing or halting rates. Hence, we've got a special episode. We're going to go into what has happened since the Reserve Bank has increased interest rates and what's meant to be happening. But we're also going to look at what happens if the RBA actually stops hiking rates and what effect that will have. We're going to go into why Australian stocks have been the outperformer in terms of all asset classes since the 1900s. And we're also going to look at some sustainable investing tips. So hold on to your hats. This is going to be an exciting one. For all of you who are out there in socials land, guess what? If you want to watch the whole episode, please head on over to the podcast or YouTube channel. We're also on Spotify, so find us at Real Wealth with Stefan Angelini. For any of you that's hanging on, thanks a lot. Really appreciate all the feedback we're getting. Just an FYI, this is just general information. Please don't consider it as personal advice. And if you want any personal advice, guess what? Go and speak to your licensed financial planner. And that's what we are. We are financial planners at Angel Advisory. So if you have any questions about your own investment portfolio, reach out to hello@angeladvisory.com.au. Now, let's get into it. The Reserve Bank currently have rates at 3.25%. What if they increase another 0.25% today when they meet? So they meet on the first Tuesday of every month, and they say whether we're going to increase or decrease rates or just keep them on hold. So you would have noticed that rates have just been going up as of recent, and a lot of economists are expecting rates to continue to go up for at least the next little while. So to increase rates, March is a fairly certain that rates are going to go up again, and then everyone's pretty confident they're going to go up in April as well. So that'll bring us to a 3.75, 3.85% rate area. So the Reserve Bank cash rate. Now, if you've got a home loan, the home loans normally trade at around about 2 to 4% above this. So it's going to put a lot of pressure on houses or people who own houses. But what if it slows down? What if they stop before they're expected? What will happen to the markets? We think that markets will jump a lot faster because there are already rate hikes built. There are expectations that rates will stop at 3.85 or over the next April, May. So let's look at what's actually been happening. So the tightening of the monetary policy has begun to have effects on the economy and economic activity. Well, house prices are down, credit growth has slowed, building approvals have pretty much stopped, and the housing sector is feeling pain. And that is as a direct result of the tightening monetary policy or increasing interest rates. Consumer confidence has also started to come off and started to collapse. Household spending we expect will start to slow down, although it hasn't slowed down too much just yet. But just remember that these are lagging indicators. So the monetary policy is implemented, the Reserve Bank increases rates, and things don't start being felt until later on, till it really affects people's hip pockets. So right now, the economy's got some momentum, and you can see that because our GDP has still been increasing, but we can see some slowing coming up towards the end of the year. So quarter 4, 2023, as we might see our GDP or our growth go to close to zero is what we think. So what we think is that rates will most likely go to 3.85%. If they go a bit more than this, then you could imagine that markets will be impacted. When I say markets, stock markets in particular. Now, this is where you probably want to make sure you've got, we call them value companies or profitable companies that have the balance sheet to last throughout rate cycles. Now, we don't know when we are going to have rates come back down, but there are expectations towards the end of the year or early next year. Now, if the Reserve Bank come out today and say, hey guys, look, we've had enough, we're probably going to just pause everything for now, then you can expect everything to just go pop and start to jump quite a fair bit, because the way equity markets work is they're based off future expectations. So at the moment, markets are expecting that rates will go to at least 3.85%, maybe a little bit more. If they stop or they pause, then you can expect a lot more confidence back into the market, because it's going to be lower rates of interest charged on debt and therefore more profitable businesses, and therefore see the equity market start to jump there. That would be fantastic. We'd really love that if they decide to pause it. I'm sure everyone out there with a mortgage would love to see the Reserve Bank actually pause their rate hikes, but we're not expecting it this month. So let's cross our fingers, but I can expect that will be increasing another 0.25%. We don't expect the big 0.5% jumps anymore, because the RBA should be just smoothing it out, and hopefully we can have that soft landing and not push ourselves into a recession. Just an FYI though, they do keep increasing rates quite aggressively, that could push us into a recession. So that's something we really want to watch out for. Let's look back in Australia and just focus on why Australia has been such a good asset class over time. So Credit Suisse had a global investment returns yearbook, and Australia was named the best performing asset class over 123 years. So all the way since 1900s. This was a report conducted by the London Business School, which said that basically Australia had a annualized real return of 6.43%. Now, if you don't know what a real return is a return above the inflation rate. So to get a return of 6.43% when inflation is running at 7%, you got to return a 13% return. So that's a real return, and Australia has done a 6.43% return per year on average since 1900. The USD, or the US market, was the next best at 6.38%. You're probably thinking, why is this? Given the most recent 10 to 15 years, the US market has outperformed dramatically, the Australian market particularly. Throughout the period from between around about 1940 to 1990, the US market went sort of sideways. So Australia kept kicking strong, but it's just been the last little while where Australia hasn't been able to keep up with the pace of the US because they are run by a lot of tech stocks now. So look, we are the best over time, but doesn't mean we're the best year on year and the best place to be right now. But look, we've got a lot of resources, which is why we're so good, which is why you all know out there where our economy is so protected. So we've got iron ore, lead, rutile, zinc. We've got carbon, lithium, aluminium. We've got everything you want. And essentially that has kept us afloat throughout periods of recessions, which is why we love Australia, especially when times are tough. If you are a sustainable investor, so you've got an ESG tilt, or ESG stands for environment, social, and ethical. There's a lot of opportunities. There's a lot of options for you now when it comes to investing. And a big issue around there has been greenwashing. Greenwashing is when a company says they have an ESG drive or they're sustainable, whereas actually, in fact, they're not. They just say it to try and get more investors in. So there's a really good article released by Pangana Capital Group, which has basically said that you can get good returns from being a sustainable investor, but they prefer to engage an active manager. They're for a few reasons. One, that they should outperform. Two, they should protect your capital in terms of down markets, like we've been seeing recently. So ESG is a heavy tilt towards tech. So they've been performing quite well up until 2022. But also understanding the sustainable risks of each business that you're investing into. And that's where you've got an active manager can actively go to the businesses, see how sustainable they are, and what are their main issues. They can assess their ESG ratings as well. So if you're a really ethical investor, rather than just going into an ETF, you really want to take an active approach, implement an active manager, because what they do is they will go to a company and properly assess the board, the management, and their processes to ensure they do align with the way you should be investing as an ESG investor. Finally, when you are a sustainable investor, you need to know when it's time to wave goodbye. So you can hold on to these asset classes forever. But if you remember back to the tech bubble, everyone loved tech, and that means they thought all tech companies were going to do extremely well. There are only about a dozen that end up being extremely well after that tech bubble. So just be careful of what you're investing into. Don't need to go into everything just because they say they are ESG or they're focusing on the future or green future or low carbon. Be willing to say goodbye when it's time to, because still coming to investing, you want the company to do well, but when the valuation doesn't make sense, there's no point being there. So that's it for today. Hopefully the Reserve Bank keeps rates on hold. I don't think they will, but if they do, fantastic. Let's have a party if they do. Other than that, have a great day on a Tuesday. We'll see you soon. Bye.